In the next few minutes, you're going to find out exactly how many retirees actually have $1 million, $3 million, and $5 million in investable assets. Not home equity, not net worth, but the money that can actually fund your retirement spending. Then I'll translate each tier into the real world, what it buys you in freedom, trade-offs, and in peace of mind. So you can stop chasing a random number and start aiming at a lifestyle. But before I show you the numbers, we got to get one thing straight, because this is where people accidentally win on paper, but still feel broke. So when I hear someone say, I'm a millionaire, that might mean a lot of things, but usually it means net worth. And your net worth can include your home equity, your cars, and even the gross value of a business that you might own. That's real wealth, don't get me wrong, but it doesn't automatically translate into a paycheck that you can live on in retirement. So in this video, we're only going to be counting what actually can fund your retirement, investable financial assets. So it's going to be the accounts that you can realistically tap to cover your groceries, your travel, to pay taxes out of and cover your healthcare expenses. Maybe it's your retirement accounts like an old 401k, a brokerage account, your cash, stocks, bonds, mutual funds, whatever it might be. And here's why that matters. Once you separate total or illiquid wealth from spendable wealth, the $1 million, $3 million, and $5 million story changes quite fast, because we're measuring the pile that can do the heavy lifting every single month in retirement. So let's get into it. Now, here's the part that most people don't expect. Even among retirees, these tiers are relatively rare and smaller than you might think. Using the most recent Survey of Consumer Finance's public data and looking at households where the head of the household is 65 years old or older, there are about 37 million retiree age households, okay? So of those 37 million, the number with at least $1 million in financial assets is about 5.3 million, or roughly 14%. The number with at least 3 million in financial assets is about 2 million, so roughly 5.5%. And the number with at least $5 million in financial assets is about 1.3 million, roughly 3.4%. And those are in 2022 dollars, not 2025 or 2026, depending on your when you're watching this video. So if you're watching this and you're thinking, wait, only about 1 in 7 retiree households has $1 million in investable assets? Yes, you are correct. And that's exactly why you should care, because a lot of retirement advice online, and admittedly on YouTube, is calibrated to the minority, right? It's the roughly 14% that have $1 million, or the 5% that have 3 million, or the 3% that have 5 million. So if you build your plan with assumptions that only work for a select slice of retirees, right? Maybe you're in the $1 million tier and you're looking and planning as if you're in the $5 million tier, you're either going to feel behind forever, which is what we don't want. And the prices you're going to pay is either going to be constant anxiety and worry, or extra years of working to try to get to that $5 million number. Okay, now let's briefly talk about what each tier buys you. Here's the singular focus of this video. Each tier changes your retirement problem and what that problem might look like. More money doesn't necessarily mean more or less problems. It just means different problems. As you get more wealth and more money, you're going to have different trade-offs, different risks, and honestly, different anxieties and a mental framework that you're going to need to adapt to the new reality of the situation you're in. So let's start with the $1 million retiree. If you got around $1 million in investable assets, your retirement is usually built on 3 pillars, right? It's going to be Social Security, maybe a pension, and then your portfolio, filling in the gap. Now, a simple rule of thumb that we talk about a lot is going to be the 4% rule. So a normal withdrawal environment over 30 years, you could be looking at supporting your lifestyle of about $40,000 a year from your portfolio. Now, I talk extensively on utilizing guardrails and everything else that goes into it and being able to spend in the 5, 6, or 7% range in early retirement. But for this video, I just want to try to illustrate kind of what you could expect from your portfolio in combination with other income sources. Maybe it's a pension or Social Security like we talked about. Because the $1 million retiree's primary focus is usually going to be income reliability, right? Can I fund my lifestyle? Can I make sure my lifestyle is going to survive turbulent markets, high inflation, maybe higher healthcare costs without me becoming a burden to my family or having to go back to work? At this tier, the big wins are surprisingly kind of unsexy, to be honest with you. It's things like getting Social Security claiming timing right for your household, having a withdrawal plan, like I just talked about, that doesn't implode the first time the market drops down, or avoiding avoidable tax mistakes, or having a spending guardrail system that you don't have to panic sell or overcorrect when the markets aren't playing ball with us. And the emotional goal is simple, right? We're trying to make work optional earlier on for you and keep it optional. So you never have to go back to work just for the income purposes alone. Now let's jump to the $3 million tier. And this is where the conversation shifts from can I retire to how do I retire well? Because $3 million doesn't just mean more spending. It usually means more choices. You're not just covering bills, but you're deciding what your retirement is actually going to look like. Travel can be a rhythm, not just a one-off trip every year. Maybe helping your kids or grandkids isn't just a nice idea, but it's truly on the table. And now you're trying to figure out how do I execute on that. You might even start flirting with things like a second home or spending a few months a year somewhere where you love and renting long-term. But here's the twist, right? At $3 million, the biggest threat usually isn't, I'm going to run out of money tomorrow. It's death by 1,000 little small mistakes. And the bigger one is hesitating to enjoy the life that you really already paid for and saved for and invested for. This is where I see people get stuck. They hit their number, whether it's 3.5, 4 million, whatever, but they never know when to switch gears. They keep treating retirement like it's fragile, even when the math says it's not, right? JP Morgan's retirement research puts a spotlight on something very important here. Even people with similar wealth can spend very differently based on how their income feels. And usually it's feeling of guaranteed. When your retirement lifestyle is covered by Social Security or a pension-like income stream, or having an income strategy that tells you when to tighten the belt on your spending and by how much and for how long, people tend to feel like they have more permission to spend freely. When it's mostly portfolio driven, which a lot of times people that want to retire early, it's going to be, and very ad hoc, very portfolio driven, ad hoc, not a lot of guardrails, no guaranteed income sources yet. Maybe your pension starts at 65, you retire at 63, and Social Security is still a ways away. People tend to clamp down, even if the math says they're fine. And that's where working with an advisor can really help you kind of see the bigger picture and understand that it's going to be okay. You have to do it strategically with your spending and your expenses. But there is a strategy and a plan for everyone. It's just a matter of finding that and then actually executing on it. And that matters because retirement isn't a spreadsheet experience. It's a human experience. It's your life, and you only get to live it once. Your brain truly cares less about what your Monte Carlo success rate is going to be or what it says it is, or even your safe spending capacity in our case. But it's more about, at the end of your life, when you're looking back, that you don't have major regrets and you don't have unrealized dreams that you could have reached for. Which is why the $3 million tier often shifts towards questions like, how do I build a resilient portfolio that's going to provide me a smooth income ride throughout retirement? And how do I minimize taxes over the next 20 and 30 years and not just this year, like my accountant keeps telling me to do? Okay, now let's transition gears a little bit and talk about the $5 million tier. At $5 million in investable assets or more, the retirement problem shifts again, like we talked about. For many households, the basic lifestyle math is strong. You can fund a high standard of living and still have meaningful reserves. And for some people with a lot of pre-tax, they could have RMDs that are actually larger than their lifestyle spending. But ironically, the complexity actually goes up, not down as you get more wealth. The biggest issues at this tier are often going to be around tax drag, estate planning, concentration risk, and legacy design. You start asking questions like, how do I avoid accidentally donating a huge chunk of my wealth to the government via taxes when I pass? How do I give to my family without ruining their motivation or causing fighting within our family? Or how do I structure charitable giving in a way that's meaningful to the charities I care about, but also tax efficient within my plan? Or do I need trusts? And how do I set them up? How do I structure them? And then how do I actually fund them and execute on my estate plan that my lawyer gave me? And this is the part that most people don't expect. When you have over $5 million, the mental game changes a little bit, right? You stop obsessing over, do I have enough? Or am I going to run out? And you start wrestling with, what am I doing this for? Because once the basics are covered, money stops becoming just protection and just a way to fund your lifestyle, and it really turns into a tool. And if you want, you can become an artist. So the questions get a little bit more intentional and a little bit more nuanced. And a lot of people at this tier, they don't really expect that, and they don't know how to navigate it. Do I want more time with my family? Do I want more experiences while my health is good, which we always talk about? Do I want to give? And if so, how do I do that without creating drama or dependencies, like we said? Do I want more simplicity in my life, right? Am I accidentally building a very complicated and just tiring lifestyle? And how do I help the people that I love without turning into the family ATM? So these are just a couple examples of questions that people struggle with at this tier and above. But here's the reality check that applies to every tier, including the $5 million tier, is that retirement spending, it's not a straight line. In real life, spending tends to change with age, health, and with different opportunities as they arise and as family dynamics change. RAND research using the health and retirement study finds that inflation-adjusted spending tends to decline after age 65 on average, about 1.7% per year for single households, and about 2.4% per year for couples, with only modest differences across wealth levels. That's a fancy way of saying many retirees spend more earlier on, then gradually spend less later on throughout the middle part of their retirement. And then healthcare and long-term care expenses can rise at the end of their plan. Now, why should you care about that? It's because your spending is going to change, and what your expectations are of what you need to support yourself today might not be the same as far as what you're going to need to support yourselves in 10 years or in 15 years. When Social Security kicks on, maybe your mortgage drops off and your expenses shrink. So that's why detailed planning today and into the future is so important. But now you might be sitting there thinking, Sean, why should I actually care about how many retirees have $1, $3, or $5 million? Because this isn't about comparing yourself to random strangers or the general mass public. It's about calibrating your plan to reality so that you don't accidentally chase someone else's lifestyle and someone else's focus. If you're aiming for $5 million because that's what your social media feed keeps showing you, but the retirement you actually want is already covered at, say, $1.5 million or $2 million plus Social Security, you might be trading away years of freedom that you could have taken sooner if you're still working. Or maybe you could spend more and really create more memories and an incredible time with yourself, your family, and those you love because you didn't realize that you actually had the flexibility. And if you're sitting at $800,000, but you're planning like you already have $3 million in the bank, locking in big fixed costs, ignoring taxes, no guardrails for down markets, you might be setting yourself up for a lot of stress that you didn't even need to sign up for. So here's your takeaway for this video. The tiers don't just change the number. They change the problem that you're trying to solve and you're trying to answer for. Around $1 million, the job is reliability, turning a pile of money into a lifestyle that you can sustain through turbulent markets, inflation, and real life. Around $3 million, the job is clarity, building a plan that gives you permission to spend and doing it efficiently so that taxes and hesitation don't shrink your retirement. And around $5 million and above, the job is intentionality, simplifying complexity and deciding what you want your money to do, whether it's improving your lifestyle, improving your family's life, giving, legacy, all with great purpose. So I'll leave you with this one question that cuts through all the noise. What are you actually trying to buy? Not $1 million, not $3 million, but maybe it's freedom from work. Maybe it's traveling years where your health is good and you have the ability to help your family. Maybe it's buying a second home or just having more peace of mind and simplicity. Because the moment you name the lifestyle, the number stops becoming the vanity metric and it just becomes a tool. And if you don't know what that number is for you, or you're curious if you can retire earlier based on the lifestyle that you're picturing, click the link in the description or scan the QR code on the screen. My team and I would love to help you get those answers. I hope you enjoyed this video and I appreciate you watching.